Deschanel.
I'm Sabrina Angaro.
I'm Brian Sayar.
And our sectors that we're covering is information technology and communication. So starting with information technology, this is just a graph to kind of show how the S&P 500 has been doing as well as the tech sector. It's followed it pretty closely. You can see there's only a couple of places where it's maybe a little bit more volatile than the entire S&P 500, but otherwise remains really close. Currently, the S&P 500 has 22% in tech, and SIF Holdings have 21.7%, so we're very much the same. The industries inside IT include software and services and software, hardware and equipment, and semiconductors and semiconductor equipment. This is a picture of a semiconductor in case nobody knew what it looked like. I thought it was like a Tesla coil. So. We currently have quite a few holdings in this. It includes Visa, Cognizant, Tencent Holdings, which is a Chinese company we bought last year, Conduit, Analog Devices, Microsoft. These are all pretty recognizable names. Moving on to the communications sector. Communications is a new sector that just got created after the companies were pulled out of other spots. So its graph looks a little bit different. It's harder to watch, but kind of performing the same as the S&P 500. S&P 500 is about 10% of communications, and we hold 7.6. So there's opportunities maybe to buy more communication stock. Industries inside communication, it gets a little bit weirder because they have diversified communication networks, which is like fixed line providers like AT&T, Verizon, and wireless communication services, but it also includes media and entertainment. And the media is broadcasting, cable advertising, and also interactive media and services, and those include Walt Disney is one of them, which doesn't sound like communication since they have cruise lines and theme parks, but it still counts since they have the interactive entertainment. We also hold Google in 2 different classes and Verizon Communications. So important metrics and key drivers for the IT and communications is looking at numbers of subscriptions or subscribers to see how well that you're doing. Everything in information technology age that we're in, everything's becoming automated or digital. So as far as a key driver for the industry, new companies are always coming around, and even existing companies want to become more tech savvy. The prices of gold, copper, and plastics, commodities that are used to make these products, are really important when trying to factor how much the company is making. And they're constantly improving and creating, improving obsolete technology and creating new technology.
So important economic indicators for IT and communications. One of the main ones is gross profit margin, which is sales minus cost of goods sold divided by sales. This measures how much profit they're making. The burn rate is also a very important metric. This tells you how much cash you use per month and how long of a leash you have before you either need to go out of business, raise capital, or increase your performance as a company. Your return on RORC is the current year gross profit divided by the previous year research and development expenditures. This measures how efficient your company is at using your research and development expenditures to generate profit. And also there's the customer acquisition cost. This is the total marketing and sales expenses for that period divided by the number of customers acquired during that period. And that tells you how much it costs to acquire a new customer.
Information technology, we're going to go more into the industry of software.
Okay, so notable companies in this industry are Microsoft, which pretty much everyone knows, really big company, and then Oracle and VMware. Okay, so software pestle. So political would be Trump taxes on goods imported from China and now Mexico. Economical is the cyclical, so runs through like the business cycle. Social, increasing cultural diversity and opportunity and threat. It's an opportunity and threat because you can't sell the same product to a group of different people in the same way. Technology, increased automation in the businesses, and increasing volume in trade are both opportunities. But increasing volume of online transactions is a threat because of increased cybercrime attacks. Legal, at least 35 states introduce more than 265 bills or resolutions related to cybersecurity. And environmental, increasing preference for green products, increased focus on business stability, and increased availability of recyclable materials. Okay, and the Porter's 5 forces. So for suppliers, it's low. Not many suppliers in the industry, and software is an intangible product. Supplier switching costs is also low because there are a large number of suppliers and are not in a position to bargain or influence prices. Buyers, it's medium because buyers switching costs for software is high because it takes time to learn a new software, but switching costs for hardware is low because there's a lot of variety. And substitutes is low. The substitutes of software is writing or record keeping, so it's kind of like not really a point in doing that. So existing rivals are very high. Competition, more rivals because of less product differentiation. And new entrants is medium. Threat of new entrants are low. The entry barriers are high though. Designing software is expensive and there's a lack of people who have the knowledge. So that's why it's like in the
So now we'll touch on the communications and focus on the entertainment sector. So some notable companies in the entertainment sector is Netflix, Comcast, and Walt Disney. Netflix currently has a market cap of $130 million per $1 billion. Comcast has it of $230 billion, and Walt Disney has it of $250 billion. So for the pestle in the entertainment, there's political influences and stronger intellectual property protection, shifting free trade policies and stable political conditions in major markets. This leads to more confidence in the market because the less political influence, that means the more stable the market will be. The economical area, the rapid economic development of markets and the increasing level of disposable incomes means people have more money to spend on like subscriptions or other entertainment devices like VR. The social, there's favorable attitudes towards leisure and increasing online activity. It says that Netflix uses 140 million hours of video a day go through Netflix. There's a lot more time that people have to put into stuff like this. There's high research and development rate in the industry, and that needs to be matched or beat if you're going to compete with a lot of these companies. Increasing mobile device use, the increasing popularity of augmented reality are all technology that has helped increase this sector. With respect to legal aspects, there's more environmental protection law, and this kind of leads into the increasing your environmental
Or decreasing your environmental footprint.
yeah, and also with the environmental, a lot of people use it to get good PR because a lot of their customers look at how they treat the environment and how they interact with it. And also there's improving legal protection to consumer rights in developing markets and broadening intellectual property protections. And this is all legal things that help the entertainment sector. For the Porter's 5 forces, with suppliers, it's a low force. There's a large competition with suppliers and an overall higher supply within the suppliers, which means that there's more options to choose from. Buyers have strong power within this area as there's low information asymmetry and buyers are informed of all their decisions. And there's low switching costs because a lot of the entertainment things are monthly subscriptions, so there's not a whole lot of capital that people have to invest in it as a buyer. Substitutes are moderate. There are substitutes with moderate variety, and the reason why I say moderate is, for instance, with your streaming devices, there is some things that overlap. There's also a lot of qualities that are specific to a certain company. And this leads to the fact that you need to have high quality and performance and able to retain your customers as there's going to be some competition. Existing rivals is strong as there's lots of competition with high exit barriers. You need a lot of capital to get involved in the market. There's aggressive rivals and moderate product differentiation. With new entrants, they have a low force. It's hard for them to get access to the market as you need large capital, and there's a high cost of brand development. A lot of these companies in this sector rely on brand loyalty to keep their customers, given the benefits. And part of that is they learn what customers want and what they need in order to best address what they want.
Okay, so you guys, I'll start with the very last thing you said, which is in the entertainment industry, there's a lot of brand loyalty. I'm sure in this room there are a lot of Netflix, Hulu, ESPN Plus, whatever. Someone subscribes to something in here, and probably several of you subscribe to many things. Are you guys loyal to the brand Netflix, or would you give up Netflix in a day if the content that interested you was on a different platform?
I would do both. I don't know, cause like I have Netflix and Hulu, but Hulu has like the shows that like are going like right now. So I definitely have to switch.
But it's the content, not the platform that you like, right?
That's true.
Yeah, I like Netflix.
But I guess if diving into it, talking about Disney Plus that's coming out, that would then take a lot of it. So they're not brand loyalty to the entertainment person providing it, but the content that's on it.
There we go. So this isn't necessarily something I'd expect you guys to know, but it's something that I think you guys should keep in this sector, keep an eye on. It's not so much brand loyalty, it's content loyalty. It's like the content wars right now. We have all these new emerging platforms, and there's a lot of negotiating around. It turns out like the rights to Friends, which is a TV show that stopped being syndicated like 20 years ago, is worth like $1 billion a year. So
I took it off Netflix.
They
yeah.
repurchased it for like $100 million though.
Yeah, so it's one of those things that I think about it less in terms of brand loyalty and more in terms of like who has what content, how much are consumers willing to pay for all these different subscriptions, because now there's this kind of this unbundling where how are you willing to pay for both Netflix, Hulu, plus Disney Plus NBC's going to launch their own platform. So those are the kind of questions you should start thinking about when you think about this space. There's a reason why these two sectors are together, right? What do you guys think these two sectors have in common? Just the two industries you picked, software and entertainment. Why do you think these kind of, it might make sense to think about the two, not as direct competitors because they do different things, but what's the overlap? What do these two have in common?
I think one thing that they have in common is a lot of the entertainment like devices that people watch it on are IT based. So you almost need IT in order to use the entertainment communications devices.
So what kind of things, what are the inputs that go into making software? What do you need to make software? Because you did a 5 forces, you looked at supplier power. It's a lot easier to do a 5 forces for like manufacturing, because you're like, oh, like what goes into, making shoes, leather, right? It's really obvious, but this is an intangible services-based sector. What goes into making software?
Data and customers.
And the engineers that are able to.
Engineers, right?
Able to code.
Customers are on the other side. They're the ones who are buying it. Like data is valuable, but both require a lot of probably software engineers work for entertainment companies just as much as they do for actual software companies, right? Because that's a key supply for both. And that's why you see this as kind of an interesting amorphous sector where you'll see, like you guys mentioned, it was interesting. You thought that Disney was classified as a communications company, but the line between these different industries seems to blur a little bit. The reason why companies get classified where they do in this classification system is because the majority of their revenue comes from a line of business that is classified just by that code, so communications. Disney, streaming entertainment and entertainment in general, like TV-based things, are considered communications, right? So that's why Disney is there, even though they own theme parks and do a bunch of other stuff. I'll give you guys a little bit of feedback also. Metrics versus economic indicators. So some of the things you guys talked about is economic indicators. I don't know if you want to go back to your slide on economic indicators. So those things are what I would call metrics. When I talk about economic indicators, I talk about like GDP growth, consumer confidence. That's an economic indicator. A metric is something I'm going to use to measure the performance of the business. And so some of the things you guys talked about is metrics and key drivers. So I'd kind of clarify it. A key driver might be like something you think is important, but it might be kind of qualitative. A metric is a number that you might put on that key driver, right? But those are directly related to business performance, where economic indicators are more like, how's the economy doing? So some of them might be more relevant, like if you're in a consumer-facing industry, consumer confidence might be more relevant. But you guys did a good job of picking some metrics, even if you called them economic indicators, that I think might relate. Burn rate might be bigger for a startup and probably not for a publicly traded company that's probably well capitalized. But you guys, we haven't had all the discussion that normally I teach this course in a little bit of a different fashion, that we talk about all the metrics before you guys do this presentation, so I'm not too concerned about that. You guys did 2 kind of pestle analyses. Are there some things you think were missed in those pestle analyses in terms of trends? Because the question I really wanted was, I didn't want you necessarily to give me a full pestle, that's a tool you can use, but like, what are the big trends happening in these sectors? Is there something that you think could have been incorporated outside of pestle?
One thing I noticed within the pestle was just talking about the political part. There's been a couple different articles talking about software engineers. They don't all come from the United States. The United States kind of shutting down its borders and not welcoming in people is keeping some people out who could be new software engineers, as well as GoPro moved their production facilities from China to, and that's not software but IT, from China to Mexico because of the increased tariffs. But now the trade war is kind of also affecting Mexico. That could go up to 35% on tariffs if Mexico doesn't crack down on their borders. So.
Okay. Yeah, so that's another thing I think would fall kind of squarely in the political bucket. I'd just say maybe if you're thinking about how to present this information, when the question is like, what are the trends that are impacting these industries, I maybe wouldn't like do the pestle and keep that for yourselves and just pick the ones that you think are most relevant. And pestle only identifies kind of external big trends. There might be things that are more like happening within companies that don't quite neatly fit in any of those, that are kind of already a response to some of these. Like we talked about, like Walt Disney didn't have a Disney Plus or like these streaming channels until somewhat recently, and that's kind of a response to a change in social, right, the way people consume content. So I'd think about it and kind of present information more like that next time. Okay, thank you guys. So